This tells me that this is a bear squeeze, even though gold is close to all-time highs. I mean, this is bizarre. Um, in other words, the system, the bullion banking system, has been caught with its pants down. This is something which I think could well develop into a crisis for one or more of these bullion banks.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 27th through June 3rd, 2024, while supplies last. First, we feature 2023 1-ounce gold Britannia at just $59 over spot. We also have backdated silver 1-ounce kangaroos at $3.10 over spot. And finally, we have the hard-to-find silver half-ounce Canadian polar bears at the very competitive price of just $2.50 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always privileged to have this distinguished returning guest who has such a wide following. Alistair MacLeod, the founder of MacLeod Finance and also the head of research at goldmoney.com, joins us this Wednesday, May 29, 2024. Alistair, thank you for coming back on Liberty and Finance.
That's very much my pleasure, DK.
Our subscribers and viewers are especially, they tell me in the comments and in emails to me that they value as often as we can have you on, partly due to your astute analysis of both the financial and monetary and geopolitical situations, but also as you draw on your background as a former bank director. And we have a lot of concern, we'll talk about that a little bit later, about the stability and health of the banks, because people have been accustomed all their life to thinking that they are safe putting their deposits in the banks. And you've helped us to understand why that isn't the case. But if we could first start with something that's on a lot of people's minds, and that's the rising silver price in the face of many other headwinds that might otherwise not be supportive of that. But one of the factors that people are watching closely is the available physical silver dwindling on the major exchanges, and in the face of a burgeoning demand for that silver by both industrial and retail investors, et cetera, and even overseas investors. You've been watching that, and would like to bring us up to date on what you're watching on the physical tightness of the silver market. Are we reaching a crisis point of available physical silver?
Well, we could well be. It's perhaps slightly different from what everybody thinks. The fascinating thing is that, yes, we know silver is an industrial metal. It is priced as such. I mean, when you've got a gold-silver ratio, I'm looking at my screen, of 73 times, that is not pricing it as money. But it does respond with gold as if it was a junior form of money. So, it hasn't gone totally. What is so interesting, I find, is the complete lack of interest in Western capital markets about silver and gold, while at the same time, there is enormous demand, obviously building up in Asia and particularly China. Silver has, if you like, an additional factor driving it. One is that India is now expanding its economy quite rapidly in the direction of photovoltaic cells and similar, if you like, environmental manufacturing activities. And I'm sure that major Indian corporations like Reliance Industries have been cleaning out COMEX vaults. I mean, the amount of silver that's been stood for delivery is really quite dramatic. Particularly when you bear in mind that the futures market is not meant to be a delivery market at all. I mean, the only reason that you have a delivery facility is basically to notionally tie the future to the price on expiry. So that is interesting. But I think for both gold and silver, it's worth understanding the position of the Chinese. Just look at Chinese households. Chinese households save roughly 35% of their income. That is huge. It is enormous. And given the size of the economy, which in US dollar terms is roughly $18.3 trillion in GDP. 35% of that is about $6 trillion. Now, $6 trillion of savings, where does it go? Well, if you look at property, that's yesterday's story. After Evergrande went bust and all the rest of it, all those problems. And you can see that the amount of land now being developed, it's just fallen off a cliff. There is no demand for property in China now, residential property. So that's gone out of the window. Stock market, well, for the last 3 years, it's been a pretty poor deal. It's gone down. It's gone up this year, really, since about January the 1st. It's up about 8-9%, something like that. But, if you're an investor, if you're a saver in China, you've probably got in your mind the fact that you've lost a lot of money, or you would have lost a lot of money if you'd bought equities over the last 3 years. So it's not going there either. We do know where it's going. It's actually going on bank deposit. And there is a difference between our banks and Chinese banks. The Chinese banks are effectively backed directly by the state. So, a Chinese individual feels really quite comfortable having 3-year, what they call certificates of deposit, giving them an income of 3% over 3 years, 3% annually over 3 years. So that is where they put it. Now, this is effectively risk-averse stashing of savings. All these banks, coincidentally, offer gold savings accounts. So if you've got a minimum of, say, 500 or 600 yuan, which is roughly $80, then you can open one of these accounts. Now, I don't know whether these big banks run their gold accounts on a fractional reserve basis, or whether they actually back it properly. But I would have thought that they're not going to get themselves into the same position, if you like, as their bullion bank cousins in the West. So, demand from customers switching from ordinary deposits into bank deposits, I would have thought, goes, pretty directly via the bank into gold. They also have apps in China. You've got these apps, and you can buy and sell gold on an app. I mean, we've got that sort of thing over here as well, but they've got it in China. Don't forget it. And from what I understand, very much unlike us, where we actually have very little interest in coins and bars. You have to be a bit die-hard to be interested. In China, they're queuing around the block to buy gold, jewelry and small bars and items like that. The big stores are literally selling out every day. So there is huge, huge demand. And this is not necessarily reflected in the withdrawals from the Shanghai Gold Exchange, because the big banks, in accumulating gold on behalf of their customers, don't take it out of the Shanghai vaulting system. It remains in the vaulting system, so it's not effectively delivered. So there's a huge, great iceberg, if you like, of gold. We only see the tip of it in the form of deliveries actually accumulating on behalf of the Chinese people in the vaults. Now, to give you an idea as to what 35%, in other words, 6 trillion of savings actually buys in terms of gold, is the equivalent of about 75,000 tons of gold. Now, obviously there isn't the gold available, but now you can begin to see why the Chinese, who traditionally have always regarded gold and silver as money, are buying both gold and silver. And the problem with silver is that it is a very illiquid market. It is consumed. It is taken out of the vaults. If you look at the numbers from the Silver Institute, you see that the reserves, if you like, that are being drawn down are in, according to them, in the LBMA's vaulting system and also in COMEX. But, it's running out of the door. So the bullion banking cohort, if you like, in the West, finds that they've got a problem. I mean, they're too used to running the market up and down to generate enormous trading profits, and quite happily run fairly large short positions in the process. But now they can't cover their positions. And we're seeing this very dramatically in the price of silver, more so than in gold, where there is actually greater liquidity. But I think that's the background really to what is going on in both gold and silver. And the fact that silver is outperforming gold really dramatically is a reflection of the lack of liquidity relative to gold in the silver market.
Do you foresee in the near term or midterm a dramatic response of the price of silver to this physical drawdown based on the physical depletion from both retail investors and industrial demand from the major exchanges?
Yeah, absolutely. And I wouldn't rule out the possibility that this drives COMEX into a force majeure situation on the silver contract. Before they do that, they will probably raise the the margins 2 or 3 times. But I mean, the performance on these contracts is bizarre, if you like, from the bullion bank's point of view. I mean, I was looking at the gold contract, and yesterday I think I'm right in saying that you had a small rise in the price of gold. The reason I'm looking away is I'm just trying to find the information. A small rise in the price of gold, but guess what? The outstanding interest fell by 12,500 contracts. Now, this tells me that this is a bear squeeze, even though gold is close to all-time highs. I mean, this is bizarre. In other words, the bullion banking system has been caught with its pants down. This is something which I think could well develop into a crisis for one or more of these bullion banks.
You've also been writing and researching recently about the persistent impact of inflation that has been underestimated, underreported, underadmitted, denied, spun, and basically the truth has been withheld from most people about the true nature and the impacts of inflation. You've been looking at it from a different direction, and I'd like if you would to share that with our viewers and our subscribers so that we get your view of where we're standing with inflation and the outlook going forward and what the likely impacts will be. And you've been looking at multiple drivers that are not being admitted, but are actually being exacerbated by the current administration that are going to be fueling inflation going forward.
Yeah, no, that's right. I'm releasing an article tomorrow, which is looking at this subject. And of course, I have been talking, and others like me have been talking about the consequences of the budget deficit and how that feeds into undermining the purchasing power of the dollar. The other thing that it does, it actually conceals what's going on in the real economy, because if you look at the budget deficit for this year, it's going to work out in the region. It's been running in the region of about 9%. Now, if you look at GDP, that has been growing by something like 4.5%. So 9% minus 4.5%, 4.5% minus 9%, tells you that the private sector is actually contracting. So the idea that the US economy is looking jolly good and, lots of demand and all the rest of it, particularly when unemployment figures are continually being revised upwards, unemployment, that is, employment down, you can see that all is not well in the American economy. And I have to say that it's the same situation in the UK and also in other jurisdictions. The point about the debasement of the currency through government spending is something which I don't think people are paying too much attention to, but it's a very, very simple thing to understand. What is less easy to understand is the impact of trade policies on inflation. President Biden, as I understand it, is introducing or has introduced a 100% tariff on Chinese imports into America of electronic vehicles or electric vehicles. There are various other high-tech products coming out of China, which are deemed, if you like, to be undermining of US manufacturing businesses, which are similarly being taxed, not at 100%, but up to 50%. Now, the consequences of this basically are the consumer faces higher prices. It's as simple as that. But we can take it one further and just look at what happens when you raise tariffs by a significant amount. And the example we have, of course, we go all the way back to 1930 when President Hoover signed into law the Smoot-Hawley Tariff Act. Now, the consequences of that were to drive the US economy even deeper into the recession. You had 25% unemployment, you had a 36% collapse in GDP, or the economy, if you like, because they didn't have GDP in those days, and you had a 40% collapse in the number of banks. I mean, 40% of the banks went bust. This was very, very serious. And, not only America, but the whole world was driven into a depression as a result of these trade tariffs. Because, when America introduced the Smoot-Hawley Tariff Act, other countries introduced their tariff acts, in response. It completely screwed American industry. Importing stuff, sort of, if you like, vital components for manufacturing. The tariffs jacked up their prices as well. I mean, the whole thing was just complete nonsense. We are going down exactly the same route. I mean, the things are slightly different, admittedly. This is an attack against China, but it will spread around the world because other countries, like the EU, will not want China to dump EVs into the EU. So they're going to raise their tariffs as well. So you can see that this is something which becomes a tariff war. China herself is bound to start raising tariffs against American imports into China as well. And then consider the position of companies with supply chains going into China, like Apple, for example. Actually, all their iPhones and stuff are manufactured in China. What's that going to do? It's going to kill these businesses completely. Now, I haven't monitored the share prices of these businesses, but if they haven't really gone down, then as this works through, they will be very, very badly affected. So this is the ridiculous thing. What it does is it drives up prices. It drives up prices from the production cost end, and either businesses manage to get the prices to stick, or they go out of business. So what does the government do? If big businesses start going out of business because of these tariffs, they will merely support them. And they will merely support them because the banks will go bust as well if if large manufacturers in America are allowed to go bust because of these damn tariffs. So the whole thing is absolutely crazy. The consequence is that not only will you see from the monetary end the debauchement of the currency, debasement of the currency, driving prices up, but also from the tariff end, you'll see them being driven up as well. You're going to get inflation running at far higher levels than the current level. I personally think that this is something which is going to be exacerbated even further because foreigners, it just so happens, don't want any more dollars. They don't want any more government debt, that's for sure. So the question then is, what level of interest rates, what level of bond yields will be required to stop foreigners liquidating their dollar positions? I don't have an answer to that. I mean, how high? I don't know. This could go on and on and on. We had a similar situation in sterling back in 1976 when we had to get the IMF in to support sterling. And interest rates, I mean, I can remember the launch, and I've said this before, launch of Treasury 15.5s of 1998. A 15.5% coupon on a long, I think that was a 12 or 15 year bond. Just imagine what that does to US government finances. I mean, we've got something like 130% debt to GDP. It's completely untenable. I mean, it's these political policies, and the politicians seem totally unaware of the dangers that they're creating for themselves. They are destroying the dollar. They are destroying financial markets. And, if you're going to see bond yields rising under that sort of pressure, forget equities. I mean, they are going to collapse. I can remember we had, by the end of 1975, the FT30 index, which we didn't have a FTSE 100 in those days, but the FT30 lost roughly 80% top to bottom in that bear market. This time round, will it stop there? I don't know. Anyone who thinks that holding on to equities is sort of, a real asset and it's an inflation hedge and all the rest of it, I'm afraid it's up for a very nasty shock, because the pricing of it will be based on interest rates and, bond yields, and they are going a lot higher. This whole idea that you're going to get lower interest rates I think that Jay Powell and his colleagues actually do have some inkling of this. They do understand that this is a problem. They're keeping very quiet about it for obvious reasons. But if I was in their shoes, I'd be terrified, because there's no persuading the political class that, how they should act. I mean, interestingly, I was called in to advise a central bank in Europe a bit over a month ago on these matters. And I pointed out to them the dynamics leading to higher interest rates. They didn't disagree with what I said, but you could see that they were concerned, very concerned about what happened, what the consequences would be, particularly because in this country, which should remain nameless, there's the government finances actually look pretty good on paper, a lot better than ours, a lot better than yours. But the problem is that the private sector has enormous debt, and this debt is in the form of mortgage debt. And if you get higher interest rates, it's just absolutely going to bankrupt individuals, the banking system, the mortgage companies, the whole thing. That was what worries them. I talked to these, and this is at a high level. I mean, we're talking at board level. I talked to them about this and said, are the politicians, cognizant of the danger of having such high leverage in the property market, and are they prepared to do anything about it? And I was told that the last thing that they were prepared to do was to free up the rental market, which of course would make, the reason people are having to buy properties at such high leverage is because there's no rental market. You're either out in the street or you pay a hell of a whack in order to buy a house or an apartment. But politically, it's an absolute no-no because landlords are evil. I don't know, whatever the logic is. It's a socialist logic. We have it in the Labour Party in this country. We actually have it in the Conservatives to a degree as well, though, the message there is a bit mixed. It's the political class which refuses to do anything. And this is why the whole thing is going to be crisis first, solution second. The politicians actually have to have their backs up against the wall before they will actually address these issues. So I do feel that the central bankers, these are not people I would automatically express, sort of support for. Let's put it that way. But I do feel that they are in a real bind. And the problem, I think, is really with the politicians more than the central bankers at this moment. I know that most of the viewers to your channel will say, well, the central bankers have messed up the whole thing. Yes, they have. Of course they have. And they don't know what they're doing. They bought the Keynesian line. They don't actually understand how free markets work and all the rest of it. But they've now got themselves into that end point from which there is no escape. And they turn around to the politicians and say, well, the only thing you can do is A, B, and C. And the politicians look at them and say, you must be kidding. They're stuck, absolutely stuck. And that, I think, describes where we are, really.
There's so much that you just covered there. My goodness. First of all, when you mentioned that we've seen this before, this setup with trade tariff wars escalating and retaliating, and it shutting down the economy, and that killing business, and that killing employment, and that killing the banks, and killing the bond markets, and killing equities. You mentioned Hoover administration having done that before in the Smoot-Hawley era. The homeless crisis across the U.S. with masses of unemployed and people who can't afford this unaffordable housing market back when it was Hoover's presidency, those were called Hoovervilles, those shantytown camps of people who didn't have proper homes and had to build their makeshift shelters out of cardboard boxes or wooden crates or something. Those were called Hoovervilles in honor of President Hoover. Also, the author, Wayne Jett, the author of Great Depressions Then and Now, Fruits of Graft, about the Great Depression, talked about that the political policies of FDR, et cetera, actually lengthened and worsened the depth and the impact and the pain that was felt by the ordinary person of the Great Depression. And it draws to mind when you talked about the corner that central bankers have painted us into and painted themselves into, and then how the rational solutions, the ways out, seem politically unthinkable or unpalatable to the political class. It almost begs a question, and I'll go ahead and ask it, about if this is so visible, so obvious. We've been through this before, and it's so destructive, and yet here we go again. Is it, in fact, perhaps, as they say, too stupid to be an accident? Is there a bigger agenda here to go ahead and crash the current financial system and replace it with one that, as most crisis response cycles do, will lead to loss of privacy, greater control by the state, et cetera, et cetera? Your thoughts on that last question?
Yeah, I mean, I don't think this is planned. Conspiracy theorists and all the rest of it think, that they've got it in for us. They're taking away our freedom and all the rest of it. It's the sort of slightly wrong order of events. They're messing things up. And the response, if you like, is that they need to retain control. And it's then that we start losing freedom. It's not a deliberate plan to take our freedom away at the outset, if you see what I mean. It's circumstances that have driven the authorities in that direction. Now, having said that, it's now gone, I think, beyond that simple, which is the order of events type story, to one where increasingly politicians around the world and the leaders of big industries are getting together to try and find solutions. And this, of course, is World Economic Forum type stuff. We face an election here, a general election in next month, in July. Just looking at what the Labour Party, the leader of the Labour Party, Sir Keir Starmer, looking at what he's saying, looking at what he is, he's a sort of World Economic Forum robot. And I can see that if Labour get elected, I can see the direction in which he's going to take this country. I'm not saying that the incumbent Conservatives are all that much better. I don't think they quite realize either, because, but at least people like Rishi Sunak do understand the need for sovereignty. For this country to have its own rules, regulations, sovereignty, and all the rest of it. He gets that. But, the Keir Starmers of this world don't get it. And I'm afraid around the world, we have a lot of leaders, and I would put Biden into this camp, who think that the problems can be resolved by getting together on an international forum to resolve them. And that inevitably leads to even less freedom for individuals to escape from where they are. And I am sure in my own mind that this is the thinking behind CBDCs. Where and this was actually said by Augustin Carsten, the head of the Bank of International Settlements, which has been sort of coordinating all the sort of research efforts and all the rest of it into this. CBDCs will allow a central bank to direct credit in directions which it believes will benefit the economy. In other words, with CBDCs, we're moving towards a situation where the government decides how the economy runs, not industry. And they are working with industry in order to achieve that objective. So this is, as far as I'm concerned, the quicker we have a real crisis to stop this drift away from free markets and from personal freedom and all the rest of it, the better. We won't get it immediately, obviously. When things get really bad, you're then into, if you like, the sort of Hayek territory, if you like, of, are we going to get a leader who is a strong man and turns out to be a Hitler? Which was the road to serfdom. We don't know. But the one thing is for sure that I think that the authorities, if I can put that in inverted commas, are worried about the situation. And the escape that which they see is even greater, damping down on our activities in order to save the system, if you like. So this will involve even greater restrictions on freedom. And returning to Keir Starmer, effectively it's communism or fascism, probably fascism rather than communism, actually, because the involvement of big business turns it into a fascist socialist solution rather than, if you like, a communist socialist solution. So, answer your question is, the order of events, I think, started out in an understandable direction, but it's now got so bad that actually whether loss of freedom is cause or effect is actually immaterial. I think it's going to get worse from where we are. And, of course, the other problem that we have is that, we've all got ourselves into wars which we can't win. How's that going to play out in an election year? This is a very big question. So,
another aspect of what you were talking about was the lack of foresight when you have these leaders that stand up and say, we're going to get tough on this other country by either taking them off the SWIFT system or seizing their accounts that are denominated in US dollars and using them for something else to actually fight against them. Or in this case, slapping tariffs on their production and that sort of thing. There seems to be this blindness of what will be likely retaliation response on the part of the other party. And in particular, China seems to often surprise those who assume that, like maybe many other countries, that China will take its actions based on what's good for its current trade balance or economy or whatever, whereas China's got other problems to solve, such as full employment of their male force. They've got the number keeps growing. It used to be 50 million extra males to females in that country due to other policies. And if those huge numbers of males become unemployed, that can be a serious destabilizing factor. And if there's one thing that Chinese culture has shown us, they don't like destabilizing factors. So this idea of, if we slap tariffs on their electric vehicles and electronics that don't come here, but you said other countries are going to want to not get dumped on because China's not going to stop producing just because there's one one particular country is no longer showing the demand for that particular product, they have huge political risks to stopping, impacting their employment, that sort of thing. So their retaliation is almost assured that's going to spill over into other countries and backlash from other countries. So it seems to be a lesson we keep learning over and over again, or not learning. Now, you mentioned along the way the pressure that this is going to put on businesses and on the banks. Can you give us an update of your assessment of the current risks to the banking system, both in the U.S. and abroad, and these developments that you're describing of persistent high rates of inflation, of banks struggling, governments struggling to afford their debt in a rising interest rate environment, et cetera, how that's going to impact bond portfolios and commercial loans that are at banks and other things that are impacting the banks going forward?
Yeah, I mean, I think the first thing I would say is that, banks have bank risk has disappeared from the headlines a bit. And that, I think, can probably be attributed to the decline in bond yields, the expectation that interest rates will start falling later on this year. All that sort of stuff takes pressure off the banks, and so the problem is gone away, sort of thing. But there's signs that this is coming back. We see that bond yields are generally rising again. They have yet to get to the levels which we saw last October. I mean, the US Treasury, 10-year Treasury, for example, I think just touched 5% last October. We fell to around about 3.75%, and currently we're looking at 4.58%, something like that. So you can see that they're on the way back up, but perhaps not in crisis territory yet. The interesting one is the Japanese government bond, the 10-year. The Bank of Japan has tried to sit on yields there and to stop them rising. Their target, believe it or not, was 0%. So it's now 1.08% as we do this interview. This is the highest it's been since 2011. So you can see that this is putting a lot of pressure on a system where there is an awful lot of debt whose value is falling. Perhaps not quite at the pace we've seen in other jurisdictions yet, but it is definitely falling. It's undermined completely the Bank of Japan's balance sheet. I think also is creating problems for zombie businesses, because when you have ultra low interest rates and businesses take advantage of it, they don't actually think that at some stage these rates are going to rise and they're going to have to refinance. That is now happening in Japan. It doesn't sound dramatic to us, the idea that, say, a major corporation has found that the rate of borrowing has risen by 1%. But bearing in mind that's probably risen from 0.25% when interest rates were negative to currently 1.5%. This is beginning to have a pretty big impact on the viability of these businesses. So the Bank of Japan, I think, is on the verge of having a developing crisis. I don't think 1.08% is quite enough to tip the whole system under, but there is no doubt that the yield is rising and will continue to rise. If you look at the yen-dollar rate as well, that is rising again. I mean, the number is rising, which basically means that the purchasing power of the yen measured in dollars is falling. We're currently about 157, I think, having hit a high recently of 160 before backing off. So that, I think, is continuing to be a real problem for the Japanese. And at some stage, if things continue in this direction, I think they probably will, then they're going to have to take some pretty strong action to try and stabilize the currency, because the price inflation effect of a falling currency is going to start destabilizing bond yields even further. So this is a difficult situation, and I think that if you like, it's the first canary in the Bond gold mine, or the Bond mine that we're seeing. Talking about gold, I think I haven't monitored it, but I wouldn't be surprised if the Japanese are buying gold as well, because they must be looking at this. Japanese investors, who again are big savers, not as much as the Chinese, but they're big savers. They must be looking at this and thinking, well, we better have some gold, better have some silver. Probably gold more than silver, but this is the idea of Mrs. Watanabe actually just leaving her money on deposit at the bank is getting less appealing to Mrs. Watanabe, I think. So, I think we're seeing the first signs of this beginning to be a problem, and I think it'll accelerate over the summer. And you know what? The oldest stock market advice that anyone here ever gave was sell in May and go away. Could be right this time as well.
One of the things that you've described there is rather bewildering to people in the U.S., and that is that we have been told over and over again that countries like China, like Russia, etc., are backwards in the sense that they oppress their populace, and they're not the state is only protecting itself, is not protecting the people, that sort of thing. And yet we have this official encouragement of individual retail savings in physical gold and physical precious metals in those countries, whereas there's an outright discouragement of the same in our country. And it seems that it leaves people in the U.S. exposed and without having that tangible asset that's going to carry them through tough times ahead, whereas the people in China, Russia, India are going to be better situated. Any comments from you on this apparent contradiction of the story that we've been told about freedom and the good of the people and that sort of thing versus centralization of, well, everything from food supplies to everything in our country that are making it officially politically incorrect to be a stacker and have a backyard garden and everything, and you should be just depending on the authorities to take care of everything for you?
Well, the answer is 52 years of propaganda. It's been drummed into Americans' heads that gold is no longer part of the monetary system. The dollar has replaced it. And it's also been driven into the heads of everybody who would call themselves allies of America. We now accept the dollar is money, and gold is a pet rock or whatever. The gold standard is a barbaric relic, as Keynes put it before all this. It does actually leave American citizens very, very exposed, I'm afraid, because it is propaganda, no more than that. The legal position is quite simple. It has always been that gold is money and the rest is credit. And it doesn't matter what propaganda you've had drummed into your head over the last 50 years. The law is the law. It's as simple as that. And the reason it works as a law is twofold. Firstly, it's behind everybody else's legal position. So it is truly international. It takes the nationality out of credit. The second reason behind this is that it is always credit which circulates, not money itself. Money is there to secure the value of credit. And if you detach credit from money, then it starts losing value. And you can see this reflected, if you like, in the move of the dollar, where from $35 an ounce in 1971 to currently nearly 2,400. Put it the other way around, and what you're looking at is the dollar has lost over 98.5% of its purchasing power in 50 years, measured in gold. And gold is the standard. This is not Bitcoin, which is going up and up and up and up because it's being driven by speculative demand. This is real money. Its purchasing power is relatively constant. It's relatively constant in the sense that it can maybe double or halve against certain commodities over a period of time. But that's very different from losing 98.5% of its value. Very, very different. We're going to go back to understanding that gold is money. The other thing I would mention is that I do think that the US government has got itself into a virtually impossible position, because not only does it state that it's got 8,132 tons of gold in its vaults, but also it acts as custodian for earmarked gold for other nations. Now, there was a fellow called, I'm trying to think, Frank Venerosa, who did some research into the leasing of gold in the 1990s. And he concluded that anything between 10 and 14,000 tons of gold, the 14,000 tons was roughly half the total central bank declared ownership of gold. Up to half of that was out on lease. In other words, there were two owners of it. Now, I'm pretty sure that, certainly for the last 20 years, the Bank of England, when it has leased gold, has retained it in its vaults rather than let it go out of its control. In other words, leased gold then becomes an asset which someone can then use, if you like, as a basis for extending credit. But it's never delivered. This is the important point. So, it's a sham in a sense. But the Bank of England, I think, has been getting away with it. I don't think it's the case, however, with the US Treasury. And we saw evidence that this might be a problem when Germany just wanted a small part of her gold repatriated. We also see, and this is anecdotal evidence, that every time a regime is destabilized by the US, like Libya or Ukraine or whatever, the Black Hawk helicopters come in and, sort of people who who look like special forces go and nab the gold and fly off with it. So, what's going on? I mean, it seems to me that there is a deficiency of gold in US government's hands. And when this, as the price of gold rises, this just brings greater and greater pressure on the US government. I mean, huge pressure. It's going to be, I think, we're looking at potentially some sort of crisis as this becomes known, if you like, and it will become known at some stage. And of course, China and Russia have been doing exactly the opposite thing. They are now the two largest nations by mining output. Russia just recently, but China for a considerable time. China has also, by my estimations, as a government, the People's Bank has, not the People's Bank, sorry, the People's Government, the Communist Party, has accumulated over 30,000 tons, which are not on the central bank's balance sheet. And I'm informed by sources who I have found to be generally reliable that the Russians have probably got a further 10,000 tons of gold, which doesn't show on their central bank's balance sheets, because they've got two wealth funds which hold this gold, and there could well be tucked away elsewhere. So, the Asian hegemons are wholly prepared for a collapse of dollar-based credit. They have insulated themselves against this possibility, stroke likelihood, stroke certainty. Yet America, I think, and Britain, and I look at Canada, has got none at all now, sold all their gold. We're sitting here without the cover necessary. How are we going to respond to this? And I think the first sign of trouble could well be not too far away if gold and silver prices continue to rise and it starts to destabilize the bullion banking system.
You went exactly where I was hoping we could take the conversation to who really owns the gold, because there's the saying, the golden rule, the new golden rule is, he who owns the gold makes the rules. We've also heard from The Art of War by Sun Tzu, appear weak where you are strong and appear strong where you are weak. And it certainly seems that we're seeing out, as you've described, undeclared gold positions, perhaps harbored by Russia and China, whereas questionable gold reserves claimed by the U.S. And you've done a significant amount of research in that area. I think you spoke with us about this about 6 months ago, but it certainly is concerning for those in the West who feel that our currency is nothing and based on nothing, and that we have no real reason for confidence in the validity of claimed gold stores held by our country. And so as we're heading into what may presumably be very tough times ahead, it's good to know what you've got in terms of real assets to make it through that. I guess that's maybe why many of our subscribers and viewers are taking personal action to try to shore up their family's preparedness for rough financial times by acquiring real assets. But do you have any further comments on this big picture of who owns the gold? Because if you just look at publicly available sources, you come out, oh, America's got way more gold than other countries on the official declared numbers.
Well, I mean, I think it's worth pointing out that in the battle of the hegemons, you've got America on one side, you've got China and Russia in partnership on the other. But they've also got the Shanghai Cooperation Organization and the expanded and to be further expanded BRICS, and they are looking to do without the dollar as much as possible. Now, it's very hard to see that commodities can be priced in anything else. We've always had them priced in dollars or sterling or something, most of the time backed by gold, so that, effectively they were priced in gold. The problem, I think, as far as they're concerned, is that we've now got with these nations who are rapidly industrializing, the majority of the world's population. GDP on a purchasing power parity basis is probably 35-40% of global GDP. So this is growing, and it means that we're beginning to find ourselves in a bit of a minority on almost any economic measure. Certainly in terms of population, certainly in terms of growth prospects and industrialization. And to go back to an earlier point when we were talking about China, I think that she is actually quite well on the way, probably further on the way, to switching the direction of her economy to supplying cheap goods to America, to Europe, to wherever, towards investing in infrastructure in Asia to develop those markets. And that is something which, you've got meetings going on as we speak in Astana, which is, sort of southern Russia somewhere, involving, BRICS and the plans and all the rest of it. So these are changes which are now happening. I think that central to replacing the dollar is the problem of what currencies do we use? And at the moment, they just don't seem to have a complete answer. What they are saying, I think, is that we will use national currencies. But then there is a further point which isn't really mentioned, and that is it's all very well using national currencies. You can use that maybe to measure trade imports, trade exports, and all the rest of it. But underlying this, there is a balance. So if you take the situation, say, a simple one between China and Saudi Arabia, China buys oil from the Saudis. But what China then does is it invests in infrastructure in Saudi Arabia. And so I think that, what we're looking at is not so much trade deficits and surpluses. What we're looking at is the maintenance, if you like, of a balance of payments between all the trading partners. That is the way it's going to be done. And where gold will come in is where there is a balance, unspoken for in the balance of trade between more than one party. Then they have got the option either to take one other's currency or to take Chinese currency or to use gold. And I think that's the way in which that is going. China doesn't want to be seen, if you like, as destroying the Western capitalist system. And so what she is doing is she is sitting back, if you like, on any idea that she's going to put the yuan onto a gold standard because that would destroy the dollar in pretty short order. India is in a similar situation. India is more reliant in many ways for her growth on Western markets. So, you've got actually quite a pushback against the idea that the two, the Asian nations are going to go on to a gold standard. I think the hole in this argument is Russia, because the more we put pressure on Russia, the more Russia, I think, will take economic action or take financial action against the West. It could very, very quickly destroy the dollar simply by putting the ruble onto a gold standard. The reason it hasn't done that, I think, is because of its partnership with China. And also with Iran to a large extent. I think the Saudis would be quite happy to go on to a gold standard because they share the similar objectives of trying to stabilize the value of their oil, their oil exports and oil reserves. So, so it's interesting. The more pressure that we put on Russia, we're forcing her to choose. Either this becomes an outright war as opposed to a hybrid war, or it's a financial war. And I think that when you get to that point where, you're almost sort of expect nuclear missiles to start flying, I think that Russia will go for the financial option to destroy us.
Alistair, we want our viewers to be able to keep track of your copious writings on this. You write every week about these important topics, and you have a new Substack, as well as your previous postings that you've done. Can you tell people where they can find your work and how they can make sure that they don't miss out on anything?
Yes, sure. It's at McLeod Finance Substack, and Google it. You've probably got a link there. Really, it does a number of things. I mean, I write a weekly article, which is a bit shorter than the one I used to do for Gold Money, because my audience is wider now, as it were. When I was writing exclusively for Gold Money, it was more a question of, I was being followed by economists, by people in the finance industry, and so on and so forth. I'm getting a wider audience for my Substack, and that is deliberate because I want people to know that they have been shot a line, that gold is now a pet rock and, the dollar is king and all the rest of it. I want them to be able to protect themselves, and that's the objective of the Substack. So I write articles which inform them. I analyze the geopolitical situation, much as we've discussed in this interview, and I also, if you like, act as a center of information, which is related to gold, silver, money, credit, geopolitics, and all the rest of it. So I put other people's stuff on that Substack if I believe that it helps. I mean, for example, I have put some of our interviews onto it for that reason. And the other thing is that there are a number of very active, sort of members, paid members who communicate with me and with each other and all the rest of it. And there's a running sort of blog, which is very useful. That's a further source of information for people who are just watching the blog, maybe not participating. So it's an all-round thing. It's not just it's not just a sort of a migration of what I do from Gold Money to Substack.
And folks, if you don't want to miss a single episode with Alistair on Liberty and Finance, make sure you do go to libertyandfinance.com. Our mailing list is free. You just put in your email address, click submit, make sure you confirm on the confirming email. You'll get every interview with Alistair and our other guests, as well as our weekly specials, one email per day in your inbox. We won't spam you and we won't share your email address with anyone else. So, Alistair, just as always, on behalf of all of our viewers and subscribers, thank you for joining us on Liberty and Finance.
That's very much my pleasure.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 27th through June 3rd, 2024, while supplies last. First, we feature 2023 1-ounce gold Britannia at just $59 over spot. We also have backdated silver 1-ounce kangaroos at $3.10 over spot. And finally, we have the hard-to-find silver half-ounce Canadian polar bears at the very competitive price of just $2.50 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.